Hi, I'm Tobias Carlisle. This is the Acquirers podcast. My special guest today is Evan Tindell from Bireme Capital. We're going to talk value investing, poker, MIT, coming up right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Bireme is an interesting name. Why is it called Bireme?
So Bireme is an ancient Greek warship that is agile enough to do damage, but sturdy enough to last in troubled waters. So we thought it was an apt name, and all the Greek gods were taken. But and then the other thing is that me and my business partner, are two people, and there's two sets of oars, which distinguishes it from a trireme. So we thought it fit.
And so it's a wealth management firm, but you run hedge fund like strategies, and you're responsible for the fundamental value strategy, which is what we're talking about today.
Right. Yeah. My title is Chief Investment Officer, which doesn't mean much when there's only two people. Someone had to be CIO and someone had to be CEO. So I decided to take CIO. But yeah, I spent all my time basically on the fundamental value strategy, which is sort of like a bottom-up stock picking strategy. Yeah.
Well, let's talk about that.
Sure.
What are you looking for when you're sort of hunting? How do you characterize the style?
Yeah. So I guess, basically think that mispricings in the market are caused by mistakes that people make. So I used to be a professional poker player, which we can get into at some point. But I see kind of investing as essentially like a game like poker. And I know you play chess as well, right? And chess is the same way, where the way to win at any of these games is you have to see the mistake the other player is making and you have to punish it, right? And so we think that the only way to outperform the market is by punishing the mistakes of other investors. And so we try to look for those mistakes in the market. And we think they sort of fall into common themes that are related to cognitive biases. So if you're familiar with like Kahneman and Tversky, they categorize this long list of cognitive biases that are basically glitches in the way human beings think, that are there because we evolved to not get eaten by tigers rather than plan for the long term. So we're kind of geared to see one tiger and then expect a tiger every day, or see the obvious thing that is is like looks most threatening without really like delving deeper to understand, if you look under the hood, is it such a problem? And it just has to do with the risk rewards of the environment that we evolved in, but it kind of caused these glitches to be buried deep in our psyche. And so we think the way to sort of repeatably find undervalued stocks is just by finding situations where we can really articulate how the stock is mispriced and what the cognitive bias is that's sort of driving it. And that's kind of the hunting ground that we like to prey in.
So there's two ideas there, right? There's the cognitive bias that's creating the opportunity, and then there's the mispricing. So let's talk about the mispricing first. How are you assessing a mispricing? Are you looking for like deep value to liquidation, or are you looking for compound growth?
I do DCFs on everything. So I mean, I'll look at comparables. I'll use multiples as a initial screen. I mean, I love looking at, as an example, bombed out industries, or industries that just have low multiples in general, and trying to find that one company that's not really like the other ones, that's like not, we call that representativeness bias, where investors just kind of see a group of companies that are kind of the same, and trade them all at 8 or 10 times earnings. When there's one, that's really different. And the example of that I like to use is Apple. I mean, it's kind of the super popular now, right? Because now Apple trades at 30 times earnings. But back in the day, everyone said, hey, Apple's a hardware company because the thing that when you buy an Apple product, you buy a phone, right? But really you're buying the software. You're buying like when my mom buys an iPhone, she's buying it so that she can FaceTime us, not because she cares about the bezel or whatever.
Yeah.
Like if she could get that FaceTime somewhere else, she Android might have a chance with her, but they don't. So we like to look for things like that where there's an entire industry that's bombed out, and then we'll kind of try to wrap our mind around whether it truly is a cognitive bias, because obviously things are cheap all the time for reasons that are correct, right? But so we spend time trying to work through whether we think that like this, in the case of like representativeness bias, like whether we think the business is actually different than the other ones. And then we'll do a DCF and just kind of make sure that we think it's cheap and has sort of a double-digit IRR going forward. And so we just try to build a portfolio of 10 to 15 stocks where we think we can, it has a double-digit IRR, and we have reason to believe that like the market is mispricing it in that way because of this cognitive biases.
So these tend to be undervalued businesses in the sense that you're not looking at balance sheets that have got some unlocked value. You're looking for businesses that are just being misunderstood. Yeah.
So I would say we will look at balance sheets. We'll look at some of the parts stories. I will look at that, but for me personally, I always want to see it pencil out to free cash flow at some point, right? Because a good example is we were long Fox a few years back, and that obviously ended up well because they ended up selling the company to Disney, but it had a really good sum of the parts story. And the sum of the parts story was, they owned a variety of assets that had, some of them had pretty good current cash flows, whether it was, Fox News or, some of their cable channels or the movie business. But they also had some other things that we thought were very valuable and not captured in the valuation of the company, but also we're going to generate revenues and profits down the line, we thought. So they owned, a good example is they owned the largest satellite TV company in India called Star India. And I mean, they were growing pretty quickly and the profitability was going up quickly. And so you could actually, not only was it a sum of the parts if you sort of added up the value of all the pieces of the business, but it also was going to pencil out to free cash flow in like, over like the 5-year time frame. So I think some of the parts gets a kind of a bad rap, but it's 90% of it is because people are just slapping multiples like 11 times EBITDA on things that aren't making any money. And it doesn't make any sense to me, right? Like you can have a sum of the parts, but it needs to, if the parts are actually worth, if the part is worth 5 billion, at some point it has to generate cash flows, right? I mean, like in the case of Fox, it was a little tricky because they owned something that was really valuable was they owned 30% of Hulu. And that was probably going to generate losses for a while, but basically all of their other businesses that were sort of hidden assets were kind of on the cusp of making money. And so we do some of the parts and things like that, but we always want it to pencil out to free cash flow. That's kind of my bias in that way, that I like to see the actual IRR.
When you're constructing the portfolios, you said 10 or 15 holdings. So how do you think about sizing? How do you think about diversification?
So I think the data shows that the benefit of diversification goes away pretty quickly beyond 10 or so names, as long as you're not buying 10 stocks in a single sector. Because as long as the stocks are relatively diverse in what they do and are sort of moving. Of course, they're going to move with the market, right? But that's any portfolio, right? That's if you have 500 stocks, they're still going to move with the market to some extent. But if the 10 of them have sort of different key factors that are driving the business, the benefit to diversification, I think, goes away pretty quickly, just statistically. So we think that's kind of our sweet spot for, being able to, I mean, especially as one person, being able to research that many companies deeply, or research any more than that deeply, is just, non-existent, obviously. So, we size things. We're willing to size in and just come in. We're willing to come in with a 10% position right away. I mean, as long as we're comfortable with the valuation. I mean, we're obviously pretty picky about the stocks that we buy, but if we're comfortable with the story, I mean, for me, I'm not a huge believer in, taking a toe hold position to like monitor the stock. I don't see why you can't just monitor. I mean, I get that it's real, when it's real money, it's a little different, but I mean, just put it in a spreadsheet, man. It's like, you can monitor it fine, I think. just have a watch list. But yeah, so we're willing to come in with 10% positions. It gets a little bit trickier. A couple of the stuff we bought in March of last year tested our concentration limits, I should say, because of how much they ran up. And that's sort of an art more than a science, right? Of when to, it's a great problem to have, obviously, to have something that goes from a 10% position to 30, but then it's like, you have to make the really hard decisions about short-term versus long-term gains, how much risk you're willing to take in one stock, if it's, to not impose that tax cost on your clients. And so those are really difficult decisions, but yeah, we like bigger position sizes for sure.
Yeah, so how do you think about trimming if it's a tax and sort of risk equation?
I think every situation is different in that regard. Like, I think having a hard and fast rule there is a little bit silly, because it all depends on the price. Like if it goes from, I mean, we had a stock go from $7 to $70 since March of last year. And so it's nice to think that you always want to take long-term gains, but when the stock is up 10x, sometimes you have to just trim the position to make it not be an unreasonable part of your portfolio. And the valuation is a lot different, right? Like I see, and this is something I hope we get into, because I hear you talk about it with Bill Brewster all the time, the whole, never sell thing. I mean, I hear you. I always know that you're going to push back a little bit against it, but I mean, honestly, it's completely a product of the last 10 to 15 years. I mean, everyone that has looked at price first, I actually got not banned. Some guy blocked me on Twitter because he said, everyone post your lessons learned the past 5 to 10 years. And I retweeted it saying, look at this list. It's a list of all the things that you hear at the top of the bull market. I never look at price. I only look at business quality. I only buy growth stocks, stay away from banks, energy, and cyclicals. I mean, there's a whole list of things that you could, and it's like the last 10 years has just been like a filter on the investment world, the portfolio manager world. And the only ones that, for the most part, the only ones that have come out on the other side with any assets or willingness to discuss things on Twitter without embarrassing themselves is people who are focused only on growth growth and how much the stock has gone up in the past year, right?
And quality. I think that
quality, yes.
Quality is one that I still struggle with a little bit, because I see the kind of there is this quality trades at nosebleed levels, but quality doesn't seem to be driven by valuation. I don't know if that's something that to your point, that's something that's like a more recent phenomenon, or if that's something that has been enduring. But there are a lot of guys out there who I think are very good investors who are purely focused on quality. And then we kind of jokingly call it quality at a reasonable price.
Yeah.
but I don't think there's anything wrong with it. I just have a little bit of trouble doing it because it just goes against my nature to pay any price for quality.
Yeah, I would say that we vastly prefer. I have a strong bias for low prices, but I have historically been willing to pay up a tiny bit for some amount of quality. Or I guess maybe I try to pay up with my time searching for the next thing to find the quality. We own, as an example, we own a hospital company called HCA Healthcare, and the thesis there is basically that the for-profit hospital business is pretty tough unless you're at a really big scale, and they're at way bigger scale than just about anyone else, and they're gonna earn $11 this year, and the stock was trading for the longest time at like $80 to $90, and then dropped to 60 during COVID in March. And I think if you look at that business, it's consistent 4 to 5. I mean, it's not going to, the thing is, it's not going to knock your socks off in terms of the growth. It's kind of 4 to 5% revenue growth, but with like a pretty long, I mean, the hospital business is insanely huge, right? So they have a really long runway for growth. And now you're paying 15, 16 times. But so we're willing to pay up a little bit for things like that, but almost never more than like a market multiple.
Yeah, I think of it sometimes as the other way around. There's stuff that deserves a discount, and you kind of got to work out whether it's sufficiently discounted from its deserving discount.
Right. Yeah, those historically, I mean, our value investing, strategy has done, a good bit better than like statistical, than like, just sort of naive value or whatever you want to call it, like whatever the indexes are. And potentially one reason for that is because of we tend to not traffic in the absolute bottom of the barrel in terms of quality, and just say like, oh, is it extra discounted? We're more of like, we're probably somewhere in between quality for a reasonable price and it's like discounted significantly for reasonable quality, I'd say.
That's a catchy acronym. I'm sure that'll take off.
Yes. That's I'll forward that right to our marketing department, which is also me. But
so let's go back to the start. You're a poker player. Sure. Did you say you're a poker pro?
Yeah, I played. I mean, the weird thing about poker is it's a little tricky to talk to some people about poker, because literally anyone can call themselves a poker pro. And sometimes it just means like an unemployed 25-year-old who's like just, living on their parents' money. But I was a pro in the sense that I was paying for all my own expenses and, putting some money away and, living well. I look back on it and I definitely should have been living somewhere cheap, but I decided to live in New York City with my friends who were in finance. Meanwhile, I was playing online poker only, so I could travel around. It was completely foolish. And I mean, the problem is when you're a professional poker player, you have to kind of, you have to you're very conscious of risk and reward at the poker table, but you're also very, you're a little bit numb to sort of small losses or small expenses. I mean, you have to be, right? It's just like managing money. You can't sweat every 1% move in the portfolio, or the only thing you'll do is watch the portfolio all day, right? So in poker, it's the same thing where you can't sweat losing $100 or you can't play the game. But unfortunately for a 22-year-old, that meant that I never sweated spending $20 on cab rides or living in New York City, and I probably spent way more money than I should have for the mobility of my job, I guess.
What do you play? What do you play? Any PLO or anything interesting like that?
I was playing mostly
Hold'em. Everybody's playing Hold'em, right?
Yeah, I mean, the thing is, so many more games. There's so many more Hold'em games, especially back then. Although, in like the real boom days of party poker, you could get a ton of PLO games going. But I mean, I was always, the level of competition and the volatility of your results at Hold'em are I think better. Although I'm not an expert in PLO, so I'm not sure. But yeah, I always played 5-10 to kind of 25-50 blinds, no limit online. So like $1,000 to $5,000 buy-in, depending on, you know, what games were going. And, you know, but sometimes you just wait around and there'd be no good games and you play for 2 hours. And you know what I mean? It's kind of weird like that. But
I guess you got to be careful. If you're a pro, you got to be careful because you're trying to make money. You don't want to be. The nice thing about Hold'em is it's just like it's the entry level game. So there's lots of people who don't really know what they're doing playing Hold'em. Whereas once you get into PLO, it's just a little bit more exotic, and it's maybe someone who's tired of
I think that's
Hold'em,
it.
so they know what they're doing.
You can get the really insane gamblers, but they usually know what they're doing a little bit. You do get the really insane gamblers, but I do think they usually know what they're doing.
PLO is a little bit more fun, I think, because it's a little bit more action, and you've always got some big drawing hand, so people stay in the hands for longer.
Yes,
all the big hands at PLO hands, right?
It actually reinforces. I guess maybe it rewards somewhat the sort of natural bias towards it's action bias. It's like, so, you know, we have a kind of a catalog for these things, obviously. And in poker, it was the biggest mistake people make is action bias. It's like people just can't sit there. I think it's the same thing in investing, right? People just can't sit there and do nothing. People just can't sit there and own like some boring regional bank and watch their money grow at like 8% a year. They want to buy the hot thing, right? And I think, you know, just like PLO can reward that sometimes, I think the market has been rewarding that for the past 5 to 10 years, that sort of, you know, the action bias.
I mean, that's the nice thing about PLO, that you throw away the low straight, or you throw away the low end of the flush, because there's a good chance that the top end of that is hanging out there somewhere still at the table.
You can get punished heavily if you. It seems like it's rewarding your action bias because you always have a quote unquote good hand. But what the bad players don't realize is that the bar for a good hand is the bar for a winning hand is a way higher. So that you end up getting crushed with hands that would obviously win every Hold'em hand. So
how do you transition then from online poker to value investing or investing?
So I made enough money playing poker that I started to not be able to use it all at the table. And I mean, obviously in poker, it's super important to manage your risk. It's equally or more important than managing risk in an investment portfolio, because at the end of the day, if you lose your bankroll, that's the end of the game. Right, that's it. Or if you even lose half of it, and then you have to like drastically move down in stakes, and you know it's all your money too, right? So there's a huge incentive to really manage your risk well. But I hadn't made enough money that I could kind of set some aside as like not my money at the table, not my poker bankroll, and then other money that I just needed to like do something with rather than sit in a bank account and earn nothing. And so I had taken some finance and economics courses in college. So I was kind of familiar with that world a little bit. And I had a friend who in college he was finance major in college. We actually at MIT, we call it by numbers. So he was a course 15 major.
That's great marketing too. That's very MIT.
Yes, it is. Yeah. I was course 2, which is mechanical engineering. But he was a finance major. And so I just started talking with him about, you know, what am I going to do with this money? Like, so I think he sent me The Intelligent Investor or Security Analysis or something. And it immediately resonated with me because it's so similar to what you do in poker. So in poker, there's the world is full of charlatans and people spouting nonsense and terrible books, terrible strategy books, just like in investing. I don't understand how they all get published. It's like, I mean, I guess the people that are publishing them have no expertise in the field, so it's like they don't really know what's, and they're just trying to see if it's like something that sold last year or whatever. So you just get all these terrible books. But there was one set of books that espoused a more rational, like kind of by the numbers, kind of like a thinking man's strategy for how to play, that like had like some theoretical frameworks around, the mathematics of the game. And so once I found this set of books, it was actually,
so like Doyle Brunson's books or something like that.
So Doyle Brunson's, I wasn't a huge fan. Doyle Brunson's were better than most, but not part of this this publishing firm. The firm was called 2+2 Publishing. They actually had a website. So the guy's name is David Sklansky. He wrote like the theory of poker, is like sort of like the security analysis of the poker world, I'd say. And so it just immediately spoke to me, because I was like, oh, I've seen this before. Like everyone else is doing dumb, crazy stuff, and here is someone that's trying to actually make a rational strategy out of it. And all the rest of just is just obvious nonsense about, sell in May and go away or whatever.
Swing trading
And candles. And there was just so much obvious nonsense out there that it really spoke to me when there was this sort of, real method. And so I started getting into that and looking at individual companies and trying to figure out what to invest in. Meanwhile, this was like 2007, 2008. So it was a pretty strange time to try to figure out, what companies are worth and, make my first initial investments. I'm sure I made some horrible trades back then that I wish I could take back. But eventually, and the weird thing is that at the same time, the poker world was kind of crumbling, at least the online poker world, because it was becoming.
Was that the crackdown? Was that when they started cracking down?
Yeah. So in like 2006, Senator Bill Frist, I'll never forget that guy's name, or he might be a House representative. It doesn't matter. Bill Frist inserted this language into some other bill. I think it was just part of a larger bill that tried to ban online poker in the US, essentially. And what it did is it didn't, I don't think it didn't make it technically illegal for individuals to play, but it made it illegal for the banks to kind of, or any US entities to be involved. And so you now had this hurdle to go through where you had to send your money to some online shell company that was probably based in Cyprus, or like, I think it was Costa Rica or something. And if you were a bad, unfortunately, like, the bad players just weren't going to go through that. I mean, just like you put a little bit of all the internet companies know this. You put a little bit of friction in the process of putting your money onto a site, and it just over time, that just makes it smaller and smaller, right? It's just like a grain of sand in the gears. So, what you had was the worst players were just like, screw it, I don't want to go through the hoops. And then the next level of players found themselves to be like the worst players on the site. And you know what I mean? And it's just kind of, it was like a natural, it was just like a natural thing where there wasn't any more money coming in really. And so the players became better and better. And so, it could still be done as a job by good players, but it was becoming a lot less lucrative. And so I started to think about, hey, maybe I'll join the real world. And, at the end of the day, the investing world is just such a wider surface of interesting things to think about. And, I was sort of comparing it to games like poker and chess. It's just such a more multifaceted game, right? I mean, one day you're learning about, a pharmaceutical company, and the next day you're learning about an Indian stock exchange or whatever, right? It's just an infinite number of things to learn about. So I always thought it was, I just immediately thought it was more compelling than the game of poker, just long term. And I think it probably also, it definitely helped my relationship with my now wife as well. And we'll have to see if she listens to this. This will be a test. But she tolerated the poker thing, but I think me being able to travel around, not necessarily, and she was in med school at the time. Not necessarily like her family loved me or whatever, but and luckily they thought I was smart, so it wasn't like a total knock against me, but it was a little bit of a knock. Like her parents both have PhDs from MIT, all, her family all have, very prestigious jobs and whatnot. So, it was definitely, it was going to be a little bit of a headwind on, on the relationship. So I think it was probably also good from that aspect, but.
And you became a value investor, and then now you've had a decade of value. It's even worse.
Right. Little did they know that value investors were about to become the black sheep.
I tell my mum I play a piano in a brothel.
That's right. They weren't attuned to that whole dynamic. So
let's go back to building the portfolios. When you're
sure.
You say it's the interesting thing, and I agree, the interesting thing about investing versus any of the games is that the games are sort of, there's only one mode of playing, whereas with investing, you're doing lots of different things all the time. But you've also got this problem where you got sort of an overwhelming number of things that you can be doing at any one period in time. So how do you kind of source what you're going to do, filter what you're going to do, validate? What's that process look like?
Yeah, I mean, I'd say that is probably by far the hardest part of investing. I guess it's probably just any job, but this is like the main job, the main real job I've had in life. But I mean, it's so hard. Yeah, it's like, I think the hardest thing in investing and being a portfolio manager is, when do you stop working on this idea and move to the next one? Like, when do you decide that you either know enough to pull the trigger, the price has moved against you so much that's no longer worthwhile, or or you just decide you're never going to be able to know enough about the name. And I feel like there's not really a good answer. I feel like it's more of an art. I try. I mean, one thing that definitely helps is having this cognitive bias framework kind of tethers me to things where I feel like that could be, like, I have at least an explanation for why that could be the, what's going on. So that kind of points me into certain types of situations. But we have a few kind of methodologies for finding those situations. I think I mentioned earlier, I like to look at beaten down sectors and just, sort of comb through those names and, just try to figure out which ones might have, the irrationality going on. I mean, I think COVID was a huge curveball to probably everyone's investing strategy. And all of a sudden, I mean, it was kind of like all of a sudden I went from, wanting to spend months or longer researching a company before I pull the trigger, to saying, hey, listen. And I think this is the art part, where you can't be too dogmatic in what you're doing in the investing world, but the prices were so insane that you had to change the rules. You had to change what you were doing. You couldn't wait around and say, hey, I want to follow this company for 6 months, because in 6 months, if you waited 6 months between June and November, you didn't invest in any of those stocks. I mean, that's probably what Buffett did, right? He and I know there's some debate about whether he should be criticized for that. I think it was not easy to just say, like, hey, we need to drop everything and start pulling the trigger on some things a little bit faster. But that I think was a kind of a strategic decision that ended up working out well. But who knows? It could have, it might have not. And I think the other good thing for us was, some of the stuff that was getting really beaten down was stuff that we owned. Like, it was stuff that we were kind of doubling down on that we already knew really well. Like, an example was HCA, where we owned it and it was a pretty big position, but then the stock went from 100 to 60, and we were like, okay, we're pretty sure that during this pandemic, hospitals are going to be made sure to be fine.
This will be
like,
a
I
boom
don't
business.
know. I mean, people were like thinking that because they were going to get overwhelmed by the COVID patients, and then maybe people couldn't pay their bills, and if people were unemployed, then like everything's going through Medicaid, which is like lower reimbursements. It turned out basically none of that was true. They earned like they're going to earn like $11 this year versus like where the stock was trading at 60. I think we got lucky that, some of the stuff lucky, right? At the time, it felt terrible, right? Because, it's like, oh, we're getting to double down on things that we already own, but we were puking. I mean, it was not fun to be down 30% or whatever it was in March, or maybe it was 35%. I forget what the ultimate number was. I mean, I think at one point in March, I was looking at this the other day. I mean, we had, in the fundamental value strategy, we had done pretty well. I'm going to pull up a chart here, but we had done pretty well for clients. And then at one point, clients had only gained like 17% net from like the inception of the strategy in 2016. And it's obviously been an insane ride since then, but like it was completely terrifying to be doubling down on those stocks. It was,
Yeah, you never
meanwhile, oh, go ahead.
Oh, just don't look at your compound returns at the bottom. It's just too
Yeah.
depressing.
And I mean, I made this joke on someone else's podcast, but the thing this time was your stocks were punching you in the face, your investment returns, and meanwhile you had little kids like throwing things at you and like running around you're like trying to click the mouse to make a trade while like pushing your 6-year-old back, being like, what are you doing, Dad? I'm like, this stock, we're putting in a buy order at $6.77 when it should be trading at $20. You got to go upstairs with Mom right now. Meanwhile, my wife has patients. She's a doctor, so she's on virtual calls with people. It was crazy.
That was a rough time. One of the things we talked about just before we came on was the spread in value. Is that something you guys follow closely, or what are your thoughts on that?
Yeah, so we do follow that pretty closely. It's something that we look at both to kind of just set our mind straight in terms of how we're thinking about the portfolio, even in the qualitative strategies, even in fundamental value. And it's definitely something my partner who focuses more on the other quantitative strategies will look at even more for the quantitative strategies. But I think if you look at the spread, the value spread, which is just the spread between the valuations of the most expensive stocks and the least expensive stocks, it's at all-time highs. I mean, it's basically right where it was in 1999. And we think that, and I'm sure you agree, that it's probably the best time relative to growth, quote unquote, growth investors. It's probably the best time ever to be invested in these value stocks, at least as far as we see the go forward returns. I mean,
how are you assessing that? That's not just price to book. You're using a variety of measures.
Yeah, right. It's a composition of price to earnings, EV to EBITDA, EV to EBIT. I think price to book is in there as well. Price to EV to sales might even be in there as well. So it's I think all of those things kind of look the same right now in terms of how kind of off the charts they are compared to historically.
What's the reason, do you think? How did we get to this point?
I think it's just the old adage of a good thing taken too far, like a kernel of truth taken to the logic, to the extreme. And I think in our letter, we grouped the the kind of growth stories in the market today in a few different buckets. One was the transcenders, which is these companies that really do have moats and really do have huge margins and huge cash flows, and which have been obviously some of the best performing stocks of all time. This is Apple and Google and Facebook. And it really was true that if you just close your eyes and bought those companies when they were knocking the ball out of the park in terms of growth in, 10 years ago, you did end up with companies with huge profit margins, huge revenues, and huge investment returns. And so I think people see that, and they see not only that, but they see they see not only the potential for that to happen, but they see the increasingly successful method of just buying things that look like they might be able to turn into that. It doesn't matter whether the companies actually end up generating the profits 5 years down the road. At least it hasn't mattered yet, really. So, if the best strategy was to go back in 2010 and buy Google, it's like, okay, we can't do that, right? So
or Microsoft.
Or Microsoft or whatever. Yeah. So like, into 2015, let's buy things that are growing that fast in our software, and and the valuations weren't that insane back then, right, relative to their potential. But nowadays, I think people have just seen that the results of that strategy has gone so well, despite the fact that most of those companies aren't generating the Google-like profits, that they're just piling in, they're just bidding up the things that look like they could become the thing. It's almost like someone sees LeBron James, the analogy being LeBron James is Google today, and saying, okay, well, if we can just find a kid, a 15-year-old kid that's a really good basketball player in Akron, Ohio, and who's 6'7", it's like, okay. And then they're paying him like $10 million a year, right? I'm like, okay, that's probably not. But then, that guy becomes a college athlete and he's doing okay. And the next person says, oh, you've done well with that. I'll pay him $30 million a year because LeBron's worth 50. And then you have the next group of GMs, or which are the analogous to investors. And they're like, okay, but that 15-year-old in Akron, he was once a 7-year-old. And maybe we could look at some other cities that are not like Akron. There's a city in China that's kind of similar to Akron if you look at the demographics. And so let's go pay, $1 million, $500,000 or $1 million a year to this slightly taller than average, Chinese person in Guangzhou. You know what I mean? Like, that's kind of the level that we're at with some of these electric vehicle companies, I think.
Yeah, that's a good analogy. I like that one. We're kind of coming up on time here, Evan. If folks want to get in contact with you or follow along with what you're doing, what's the best way to do that? I
think probably the easiest way is to join the now 3,000 Twitter followers that I have. This horde of 10 times the size of the Spartan army. It was Spartan
That's
army.
Right.
It was the 300. Yeah. Follow me on Twitter. It's at Evan Tindell, or you could go to our website, which is ByremeCapital.com/blog, or I occasionally post things under CIO Corner, which is where my business partner allows me to post things that aren't overseen by him for polish and consistency. Or you can follow our corporate Twitter, which has way less followers.
What's your corporate Twitter?
I think it's at Bireme Capital. It should be. If it's not, that's a mistake on our part. But just search Bireme Capital on Twitter and you'll find it, I'm sure.
Evan Tindell, Bireme Capital. Thank you very much.
Thanks so much, Tobias.